The President of the United States just threatened military force against a NATO ally, not Russia, not China, Denmark. And if you think this is just political noise, you're about to watch billions of dollars move across global markets while you're sitting on the sidelines. This is happening right now, and by the end of this video, you'll know exactly which sectors are about to get hammered and which ones are positioning for massive gains. Let's break down what nobody else is telling you about Trump's Greenland gambit. Traders and investors. Today we are analyzing a developing geopolitical situation that is already creating tremors across global markets. This isn't speculation. This isn't political commentary. This is about money, strategy, and how you position your portfolio in the next 48 hours. Here's what happened. President Donald Trump, speaking from Davos, Switzerland, just doubled down on his ambition to gain control of Greenland from Denmark. And when I say doubled down, I mean he stated explicitly there is, quote, no going back on this objective. He framed Greenland as imperative for national and world security. And here's the part that should make every investor sit up and pay attention. He refused to rule out the use of military force to achieve this goal. Now, let me be crystal clear about what we're dealing with here. This is not just political theater. The president has shared AI-generated images showing Greenland and Canada as part of the United States. He has leaked private messages with French President Emmanuel Macron. These are calculated moves signaling an increasingly confrontational approach with NATO allies, the very alliance that has underpinned Western security and economic stability for nearly 8 decades. Danish Prime Minister Mette Frederiksen has taken a defiant stance, refusing to abandon Greenland. We now have a direct standoff between the United States and a NATO member state. Think about what that means for a moment. The NATO alliance has been the bedrock of transatlantic trade, the foundation of European security frameworks, and the backbone of predictable market conditions in the West. Treasury Secretary Scott Bessent pushed back against what he called hysteria over Greenland. But here's what matters to you as an investor. His comments are not calming markets. Why? Because we've seen this movie before. We remember how quickly trade disputes escalated in Trump's first term. We know that reassurances from cabinet members mean very little when the president himself is making explicit threats. Lithuanian President Gitanas Nausėda has suggested that an agreement on shared Arctic and North Atlantic security responsibilities could offer a diplomatic exit. That's important because it points to potential pathways out of this crisis, but it also confirms that European leaders are taking this seriously enough to propose alternatives. Let's talk about where the money is moving right now and where it's going to move in the coming days and weeks. European markets and currency volatility. First up, European markets and currency volatility. We are already seeing nervous trading in European equities. Danish stocks are particularly vulnerable right now. The Danish krone is experiencing volatility that we haven't seen in years outside of major economic crises. Here's why this matters beyond Denmark. When you threaten the NATO alliance, you threaten the entire security framework that European markets have priced in for decades. Investors hate uncertainty, and they hate geopolitical risk that can't be hedged with traditional instruments. We're watching several specific indicators: the spread between German bonds and Danish government bonds, the movement of capital from Nordic financial institutions, the hedging activity in euro-dollar and krone-dollar pairs. All of these are flashing warning signs. For those of you with European equity exposure, particularly in Danish holdings, you need to be asking yourself right now, what is my risk tolerance for this kind of geopolitical volatility? Because this is not a standard market correction. This is a potential restructuring of transatlantic relations. The broader European markets are pricing in contagion risk. If the United States is willing to threaten military force against Denmark, what does that mean for other European nations? What does that mean for trade agreements? What does that mean for the predictability of US-European economic relations? Short-term trading strategy here. If you're holding significant European exposure without hedges, you're taking on more risk than you probably realize. Consider protective puts on European ETFs. Look at inverse positions if you believe this escalates further. At minimum, size your positions appropriately for this level of uncertainty. Now let's talk about trade, because this is where Trump's playbook becomes very predictable and very dangerous for certain sectors. Trade war redux. The president has threatened a 200% tariff on French wines and champagne. That's not a typo, 200%. He has vowed to impose tariffs on any country standing in his way on the Greenland issue. If you've been investing for more than a few years, this should sound familiar. This echoes the trade tensions that rattled markets throughout 2018 and 2019. The difference is that this time the target isn't just China. It's our oldest allies. Luxury goods companies are in the crosshairs, particularly in the spirits and wine sector. If you're holding positions in LVMH, Pernod Ricard, Rémy Cointreau, or any of the major European luxury conglomerates with significant US exposure, you need to understand that their revenue models just became significantly more uncertain. A 200% tariff on French wines doesn't just hurt French producers. It reshapes the entire US wine and spirits market. It impacts distributors, retailers, restaurants, hospitality companies. The ripple effects are extensive, but here's what smart money is watching. Tariffs are negotiating tools. Trump used them extensively in his first term, often as leverage to extract concessions on unrelated issues. The question for investors is whether these tariff threats are final policy or opening positions in a negotiation. My read, based on the pattern of behavior, is that these are maximalist opening positions. But the market can't price that in with certainty, which means volatility is going to persist until we get clarity. Actionable takeaway here. If you have exposure to European luxury goods, particularly wine and spirits, you have three options. 1. Hold and weather the volatility if you have long-term conviction. 2. Reduce position size to manage risk. 3. Hedge with option strategies that protect downside while maintaining upside exposure if tariffs don't materialize. For broader portfolio considerations, remember that trade wars create winners and losers. Domestic producers of competing goods often benefit. When French wine faces 200% tariffs, California wine producers and American craft spirits companies become more competitive. Look at those sectors for potential opportunities. Let's shift to an area where this crisis is creating clear opportunities: defense and security stocks. Defense sector implication. Lithuanian President Nausėda's suggestion of shared Arctic and North Atlantic security responsibilities isn't just diplomacy. It's a signal that European nations are preparing to increase defense spending, particularly focused on Arctic capabilities. Think about the strategic reality here. If NATO's Article 5 mutual defense guarantee is being questioned, even implicitly, European nations have to reassess their security posture. They have to ask, can we rely on the United States for defense, or do we need to build independent capabilities? This points to increased defense budgets across Europe, with specific focus on Arctic operations. We're talking about surveillance systems, naval capabilities, Arctic hardened equipment, northern logistics infrastructure. Defense contractors with Arctic capabilities or NATO contracts are already seeing increased interest from institutional investors. Companies like Lockheed Martin, Northrop Grumman, BAE Systems, Saab, and smaller specialized firms with Arctic technology are positioning themselves for this shift. Here's the specific opportunity. Arctic defense spending has been relatively neglected compared to other theaters. Climate change is opening Arctic shipping routes and making the region more accessible and more strategically important. Rare earth minerals in Greenland and throughout the Arctic are becoming critical to advanced technology and defense systems. If this crisis accelerates European defense spending with Arctic focus, we're looking at a multi-year investment cycle. These aren't short-term trades. This is a structural shift in defense priorities. Actionable takeaway. Build a watch list of defense contractors with Arctic capabilities. Look at their NATO contract exposure. Analyze their revenue mix and how much comes from European defense budgets versus US defense spending. The companies best positioned are those with diversified NATO exposure and proven Arctic technology. One caution: defense stocks can be politically sensitive and subject to sudden policy shifts. Size positions appropriately and don't overweight any single company. Diversification matters even within sector plays. Now we get to what this is really about. Greenland is rich in rare earth minerals. It holds strategic importance for Arctic shipping routes. It has untapped oil and gas reserves. It sits at the center of northern logistics and communications infrastructure. Rare earth minerals are critical to everything from smartphones to electric vehicles to advanced weapon systems. China currently dominates rare earth production and processing. Greenland represents one of the few non-Chinese sources of these materials. For investors, this creates both opportunity and risk. Companies involved in rare earth mining, Arctic exploration, or northern logistics could see speculative interest. We've already seen some movement in smaller Arctic-focused mining companies, but the political uncertainty creates significant risk that most investors aren't equipped to manage. Here's what you need to understand. Speculative plays on Greenland resources are exactly that, speculative. The timeline for any actual resource development is measured in years, possibly decades. The political risk is enormous. The technical challenges of Arctic mining are substantial. If you're considering positions in this space, treat them as high-risk, small position speculative plays. This is not where you put 10 or 20% of your portfolio. This is where you put 1 or 2% if you have high risk tolerance and are willing to lose the entire investment. The safer play is in established companies with diversified rare earth exposure that might benefit from increased Western focus on non-Chinese supply chains. Companies like Lynas Rare Earths, MP Materials, or major mining conglomerates with rare earth divisions offer exposure to the theme with less political risk. Arctic shipping is another angle. As ice coverage decreases, northern sea routes become more viable. This reduces shipping times between Asia and Europe. Companies with Arctic shipping capabilities or northern port infrastructure could see long-term benefits. But again, the timeline is extended and the political situation adds layers of uncertainty. Actionable takeaway. If you want exposure to the rare earth or Arctic resource theme, favor established companies with diversified operations over pure-play speculative positions. Understand that this is a long-term structural trend that will unfold over years, not quarters. Don't chase momentum in small Arctic mining stocks without doing serious due diligence on their actual prospects and financial stable. Let me pull all of this together into concrete trading strategies across different time horizons. Short-term strategy. The next 30 to 90 days. Expect volatility in transatlantic markets. This is not the environment for complacency. If you have significant European exposure, particularly in sectors vulnerable to US tariffs like luxury goods, wine and spirits, or tourism, you need hedging strategies. Consider protective puts on European ETFs. Look at the iShares MSCI Eurozone ETF, the Vanguard FTSE Europe ETF. Options are relatively inexpensive right now, compared to the potential downside if this situation escalates. For currency exposure, the euro and particularly the Danish krone are vulnerable to continued volatility. If you have unhedged European revenue streams or holdings, currency hedging becomes more important. Watch the news cycle carefully. Presidential statements, NATO responses, and any movement on tariff implementation will drive short-term market moves. Be prepared to act quickly. Medium-term strategy, 3 to 12 months monitor, NATO defense budgets, and Arctic security initiatives. This is where the defense stock opportunity becomes more concrete. If we see actual budget increases announced by European governments, that's your signal to increase positions in defense contractors with appropriate exposure. Track trade negotiations. If tariff threats turn into actual policy, adjust sector exposure accordingly. If they remain threats used as leverage, we'll see relief rallies in affected sectors. Keep an eye on rare earth supply chain developments. Any movement toward Western rare earth production gets accelerated by this crisis. Companies positioned in that space could see sustained interest. Long-term strategy, 1 to 5 years. This situation represents a potential fundamental shift in transatlantic relations. If NATO fragments or even just weakens, we're looking at a reshaping of global trade patterns, security arrangements, and economic relationships that have been stable for most of our investing lifetimes. Diversification across geographic regions becomes even more critical. Don't overrate any single country or alliance bloc. Build positions across US, European, and Asian markets that can weather different geopolitical outcomes. Think about structural trades. This accelerates European defense independence, rare earth supply chain diversification, Arctic development. These are multi-year investment themes that this crisis is bringing forward. Let me be direct about the risks we're facing. NATO alliance fragmentation could undermine European security frameworks that markets have relied on for stability. This isn't just about stock prices. This is about the fundamental assumptions underlying risk premiums in European assets. Escalating trade tensions could impact corporate earnings across multiple sectors. We're not just talking about wine and luxury goods. We're talking about automotive, aerospace, pharmaceuticals, technology. Any sector with significant transatlantic trade is vulnerable. Currency volatility as geopolitical uncertainty drives safe haven flows. When investors get scared, they move to dollars, gold, and US treasuries. This creates feedback loops in currency markets that can amplify volatility. Potential for rapid escalation, given Trump's unpredictable approach. This is the wild card. We've seen the president make dramatic policy shifts with little warning. The situation could calm down, or it could escalate in ways that are difficult to predict. Here's the bottom line. While Treasury Secretary Bessent urges calm, investors cannot ignore the president's explicit statements and willingness to use economic leverage. This is a developing situation that requires active monitoring. The intersection of geopolitical ambition, alliance politics, and trade policy creates a complex risk environment. But complex doesn't mean unnavigable. It means you need to be strategic, informed, and disciplined. Here are your action steps coming out of this video. Step 1. Review your European exposure. Know exactly what you're holding, what sectors those companies operate in, and how vulnerable they are to US-European trade tensions. If you can't articulate your European risk in 5 minutes, you don't understand your portfolio well enough for this environment. Step 2. Implement appropriate hedges. This doesn't mean panic selling. It means protecting downside while maintaining upside exposure. Upshot strategies, inverse positions, or simply reducing position sizes to comfortable levels. Step 3. Build your defense sector watch list. Identify companies with Arctic capabilities, NATO exposure, and strong fundamentals. Don't chase momentum, but be ready to act when we get clarity on European defense spending plans. Step 4. Set up news alerts. This situation will develop quickly. You need to know when major announcements happen. Set alerts for NATO statements, tariff implementations, and any movement on the Greenland issue. Step 5. Maintain a balanced portfolio with appropriate geographic diversification. Don't bet everything on one geopolitical outcome. Build a portfolio that can weather multiple scenarios. Remember, geopolitical risk creates both challenges and opportunities for prepared investors. The key word is prepared. Most investors will react emotionally to headlines. You're going to react strategically based on analysis and risk management. Stay nimble, watch for developments out of Copenhagen, Washington, and Brussels. Understand that what happens in the next few weeks will set the tone for transatlantic relations and market conditions for years to come. This is not the time for complacency, but it's also not the time for panic. It's the time for strategic positioning, careful risk management, and disciplined execution. That's your financial commentary for today. Stay informed, stay strategic, and as always, manage your risk carefully in these uncertain times. If you found this analysis valuable, make sure you're subscribed so you don't miss updates as this situation develops. Drop a comment below with your thoughts on how you're positioning for this geopolitical shift. Until next time, trade smart and stay ahead of the curve.